Imagine this. The fear of losing money grips you so tightly it feels like life's biggest nightmare. Welcome to the world of loss aversion, a psychological phenomenon where the pain of losing is felt twice as intensely as the joy of gaining. Research shows that this fear is hardwired into us, compelling individuals to act irrationally. Take, for example, an investor clinging onto a plummeting stock, hopeful for a rebound. Despite mounting losses, they're paralyzed by the dread of selling at a loss. This emotional bias clouds judgment, often resulting in illogical financial decisions. Curious to know what other biases might be steering your financial ship off course? Stay tuned for Part 2, where we'll dive into more biases that invisibly keep you anchored in finances. Your brain is designed to lie to you. It's not malicious. It's a survival mechanism that can make you poor in the modern world. It's called confirmation bias, the tendency to favor information that confirms what you already believe. It's a mental shortcut that protects our ego, but it comes at a steep price. For example, an investor buys a hot stock. They'll seek out positive news that praises their decision, while dismissing any negative reports as fear-mongering. They aren't seeking truth, they're seeking validation. This creates a dangerous echo chamber that can lead to massive losses. This bias is just one trap. In Part 3, we'll expose the next one. Subscribe so you don't miss it. The first piece of information you hear is often the most dangerous. Why? Because of a powerful psychological trap called anchoring bias. This is our tendency to rely too heavily on the first piece of information offered when making decisions. This initial anchor influences all subsequent judgments, even if it's completely irrelevant. For example, a house is listed for $1 million. That number is now the anchor. Even if the house is only worth $700,000, buyers will negotiate down from the $1 million anchor, often overpaying because their perception of value has been skewed. The same happens with stocks. The all-time high price becomes an anchor, making us feel like the current price is a bargain, regardless of the company's actual health. Stay tuned for Part 4. Subscribe so you don't miss it. Are you confident because you're an expert, or because you don't know what you don't know? This is the Dunning-Kruger effect. It's a cognitive bias where people with low ability at a task overestimate their competence. In finance, this is incredibly dangerous. For example, a new investor makes a few lucky trades in a rising market. They mistake luck for skill and start believing they're a genius. They ignore risks and make bigger, bolder bets, convinced they can't lose. This overconfidence often leads to devastating losses when the market inevitably changes. The wisest investors are the ones who are most aware of how much they don't know. In Part 5, we'll explore the final bias in this series. Subscribe so you don't miss it. Why do we feel an irresistible urge to join a trend, even if it seems irrational? This is the bandwagon effect. It's a psychological phenomenon where individuals do something primarily because other people are doing it, regardless of their own beliefs. It's driven by our deep-seated need for social conformity. In investing, this looks like the meme stock craze. People pile into a stock not because of its fundamentals, but because of social media hype and the fear of missing out. This often ends with latecomers buying at the peak, just as the early crowd begins to sell. The solution is to always ask why before you invest, separating the true value from the social hype. This concludes our series on financial biases. Subscribe for more deep dives.